USHY crushed FBND with a 24% 5-year return versus just 3.5%. That's nearly 7 times better performance for your bond portfolio. USHY's 30% crushes FBND's 15%, literally double the performance. That's not a small edge. That's total domination over 3 years. But here's where it gets interesting. USHY's delivered 9% over the past year, solid returns that show high-yield bonds can still perform when rates stabilize. Let's zoom in on this. FBND's 8% return lags behind USHY by just 1 point. Close competition, but USHY still holds the edge here. In plain English, total returns show us who won the race. Think of USHY and FBND as race cars on the same track. Over 5 years, USHY crossed the finish line way ahead, while FBND barely kept pace. Here's where the story takes a turn. FBND's negative 0.5 Sharpe ratio means you lost money while taking on risk, basically getting punished for showing up. Let's break this down further. USHY's Sharpe ratio of 0.1 is barely positive. You're getting minimal reward for the risk you're taking here. Now let's shift gears and look at a 0.9 Sharpe ratio means you're getting decent returns without taking on crazy risk. That's solid performance lately. In plain English, the Sharpe ratio is your investment report card. It shows you're earning better returns for each unit of risk you take. USHY's been getting straight A's here, especially lately. Let's dig into the details. FBND's Sharpe ratio hit 0.2 over 3 years, better than its 5-year run, but USHY's still crushing it performance-wise. Here's where things get revealing. The Sortino ratio at negative 0.7 confirms FBND's struggle. Even when measuring just downside risk, it's still underwater. Now let's put this in perspective. USHY's Sortino ratio of 0.2 shows it's delivering positive returns while managing downside risk better than many competitors. In plain English, the Sortino ratio is like swimming pool depth. It only cares about how deep you sink during bad times, ignoring the good waves. USHY clearly kept investors in shallower water. Here's the thing, though. USHY's Sortino ratio of 1.4 shows strong downside protection. You're getting rewarded well for the actual risk you're taking here. Let's take a closer look. FBND's Sortino ratio of 0.4 shows some progress, but it's still lagging far behind USHY's performance in risk-adjusted returns. Now here's where it gets tricky. USHY's expense ratio is just 0.08%, making it one of the cheapest bond funds you'll find on the market today. In plain English, expense ratios are like couch change that vanishes annually. USHY keeps costs low at just pennies, while FBND takes 4 times more from your returns each year. Those fees add up fast. Let's see how this plays out. FBND's 0.36% fee might seem small, but over decades, those costs compound and quietly eat into your retirement nest egg. Here's what really matters. USHY's 0.13% turnover means it barely touches its holdings. A true buy and hold fund, keeping your transaction costs rock bottom. Now let's connect the dots. FBND's 2.3% turnover is impressively low. They're barely trading at all, keeping costs down and letting bonds just sit there working. In plain English, here's the turnover story. USHYs like those loyal dance partners who stick together all night. FBND, constantly switching partners, and each swap costs you money and trading friction. Let's unpack this a bit. All right, pause time. Who's your pick here? FBND or USHY takes this round. Here's the key takeaway. FBND spreads risk across over 4,000 bonds. That's the kind of diversification that helps you sleep at night during market storms. Now, let's flip the script. USHY's concentrated approach with just under 2,000 holdings proves that picking quality over sheer quantity can drive better results. In plain English, here's the thing about diversification. FBND spreads its bets across twice as many holdings, yet somehow still underperforms. More baskets doesn't always mean safer eggs. Let's get into the weeds here. USHY's 7% yield delivers serious cash flow for income investors. That's about 7 times what you'd get from most savings accounts. Now let's shift gears and look at FBND's 4.7% yield trails USHY by a noticeable margin. You're leaving income on the table with this pick. But here's where it gets interesting. USHY delivered solid income growth, dividends up 10% over 3 years, putting real cash back in investors' pockets consistently. In plain English, USHY's income grew like the sun rising each morning, steady and reliable. Meanwhile, FBND's dividends climbed at just half the pace, making consistency the real winner here. Here's where it gets interesting. FBND's dividends grew just 5% over 3 years. Positive, but USHY doubled that rate for income-hungry investors. Here's where the story takes a turn. FBND's worst drawdown hit 17%, painful for a bond fund, but manageable compared to the stock market's brutal crashes. Let's break this down further. USHY's worst 5-year drop hit just 16%. Impressive downside control while still crushing returns compared to FBND's performance. In plain English, maximum drawdown measures your worst-case loss scenario. Here, both funds weathered similar storms, but USHY proved more resilient, taking less damage and bouncing back faster when markets recovered. Now for the real question. Nearly 3 years underwater. That's how long FBND investors waited just to break even after its drawdown. Let's dig into the details. USHY bounced back in just 450 days, less than half the time FBND needed to recover from its losses. Here's where things get revealing. USHY recovers in 15 months, while FBND takes nearly 3 years. That's critical when you're living off your portfolio withdrawals. Now, let's put this in perspective. USHY absolutely dominates across the board, crushing FBND with 24% versus just 3.5% returns over 5 years, while charging way less at 0.08% and delivering a higher 7% yield. In plain English, recovery days measure how fast you bounce back after a stumble. Like a marathon runner getting up mid-race, USHY recovered quickly, while FBND limped along much longer, struggling to regain momentum. Here's the thing, though. USHY's 7% volatility means relatively steady returns. You won't see wild swings like stocks, but you're not completely flatlined either. Let's take a closer look. FBND's 6% volatility looks stable, but here's the catch. It's slightly lower than USHY, yet delivered significantly worse returns. FBND's basically losing on both fronts here. Lower returns at just 4%, yet nearly matching USHY's volatility. That's rough. In plain English, here's the thing about volatility. It's like choosing between two roller coasters. USHY had the bumps, but delivered thrills and rewards. FBND, same shakiness, but you ended up nowhere exciting. Let's see how this plays out. USHY crushed FBND with nearly 7 times the return, yet both funds faced similar risk levels, a rare win-win scenario. Here's what really matters. That 0.28% expense gap might seem tiny, but over decades, it'll quietly drain thousands from every 100 grand you've invested. Now, let's connect the dots. USHY's 7% yield crushes, FBND's 4.7%. That's a massive income gap retirees living off dividends will absolutely feel every month. In plain English, think of yield gap like couch change. USHY's dropping way more coins in your pocket every month than its competitors, even when you're holding the same dollar amount. More income, same investment. Let's unpack this a bit. USHY's 10% dividend growth doubles FBND's 5%, helping your income actually keep up with inflation over time. Here's the key takeaway. FBND's massive 4,352 holdings couldn't beat USHY's leaner 1,947. Sometimes more diversification just means more mediocrity, not more safety. Now let's flip the script. USHY's concentrated strategy wins across the board. Better returns, lower costs, higher income, and faster recovery than FBND's diversified approach. In plain English, USHY's playing chess while FBND's playing checkers. Fewer moves, but each one calculated and purposeful. Smart money knows it's not about how many trades you make, it's about making the right ones. Let's get into the weeds here. Both funds delivered stronger risk-adjusted returns recently. The past 3 years outperformed the longer 5-year window significantly. But here's where things get revealing. USHY's Sharpe ratio jumped from 0.1 to 0.9, while FBND crawled from -0.5 to just 0.2, still lagging badly. But here's where it gets interesting. USHY's Sortino ratio of 1.4 crushes FBND's 0.4. That's 3 times better protection when markets head south. In plain English, recent performance shows both funds improving, but they're at very different speeds. USHY's hitting its stride and pulling ahead, while FBND's just finding its footing after some rough patches. Over the past year, the gap tightened considerably. USHY's 9% barely edged out FBND's 8% return performance. Here's your striking performance comparison. USHY's crushing 24% over 5 years absolutely dominates FBND's 3.5%. That's the real story. Let's break this down further. USHY bounced back in 450 days, while FBND took 1,050. That's 600 extra days your money stayed underwater. In plain English, time is money, literally. While your cash sits locked up like ice, the clock's ticking on opportunity. USHY melts in half the time, letting you reinvest and compound those gains way faster. Now, for the real question. USHY sweeps the board. better returns, lower costs, higher yield, and faster recovery. It's dominating across every performance metric here. Let's dig into the details. FBND's extra holdings and slightly lower volatility sound nice on paper, but they haven't delivered any real-world benefits to investors. Here's where things get revealing. USHY crushed it with 24% returns and lower costs, while FBND barely scraped 4% with higher fees. Clear winner here. In plain English, USHY dominated this matchup like a true victory domination battle, controlling every round while FBND just barely stayed standing. That's the kind of decisive win investors notice. But wait, there's more to this story. Long-term returns, recovery speed, and income generation, these three factors separate winning investments from the ones that'll disappoint you. So there you have it, USHY for those chasing higher returns, FBND for playing it safe with broad diversification across the board. In plain English, here's your road trip. USHY's taking the highway with returns worth watching, while FBND's stuck on back roads going nowhere. Choose the fund that actually gets you somewhere. Now here's where it gets tricky. The fine print matters. Don't invest based on this analysis alone. Do your homework first. But that's not the whole picture. If you want more breakdowns like this on bond funds, hit that subscribe button for weekly deep dives into fixed income.